In this video, I'm going to reveal why there's a potential looming financial crisis potentially around the corner and why you need to be careful and wary of the markets at the moment. Because whilst the S&P 500 and many of the stocks are up and the S&P is near record highs, the market is potentially oversold, and I think investors are way too excited about the market at the moment, and also the bond market is hiding problems. Now, I've got this information from Larry Benedict's awesome monthly newsletter. I'm not a professional trader or investor or analysis. I'm just an armchair investor, and I've just been reading his latest report in his One Ticker Trader service. If you want to join One Ticker Trade and read this and get all of his trades which focus on trading volatile markets using options and ETFs, if you want to join, link in the comment description below. But I've just been reading this, and I think it's important for you to get an idea that things aren't as exciting and buoyant as they seem. Obviously, we've got Trump's tariff, sort of all of his tariffs going on at the moment. I know that's quieting down, but that's still going on in the background. But I'm just going to give you some brief oversights of what Larry is seeing. I'm just going to read it for you. So basically, he says investors are, seeing a sense of joy, but the S&P 500 is back to near record highs. But this is basically hiding problems in the market. And he goes on to say, this includes longer-term treasury yields, which are close to breaking out over a key level. This stuff is quite technical, by the way. But just sort of take it at a high level that things could change very quickly. A breakout would signal that investors are becoming more concerned about deficit spending and debt levels. As a result, they're demanding higher interest rates to lend to the government. Demanding more compensation to lend reflects increasing risk of default. So this is the 30-year treasury yield chart. This is basically where we are at the moment. This is like a major breakout level, which could see a snapback. Larry goes on to say the 30-year yield has tested the 5% level a couple of times going back to 2023. The last time this 30-year was above 5% happened in 2007, before the financial crash of 2008. Back then, the debt GDP ratio stood at 35% compared to 100% now. High debt to GDP ratio typically indicates that a country may have trouble paying off debts. Vitally, the jump in treasury yields is causing another market to move in the wrong direction. So basically, the US economy could be in big trouble, and it could, the government could default on its debt. Vitally, the jump in treasury yields is causing another market to move in the wrong direction. Larry's talking about credit default swap, CDS spread. This term is a mouthful, but it's really simple. CDS is insurance that you can take out to protect against default on bonds you own. Think of it like car insurance. You pay a premium in exchange for a power if you're involved in an accident. For a CDS to pay, you pay a premium in exchange for protection against the bond's issuer's default. The bond issuer could be a company or government issuing debt. For CDS spread, it's just a way to measure the cost of a premium to buy insurance. When the spread or premium is rising, this implies a greater risk of default. CDS spread of US government debt are jumping to some of the highest levels since 2008, again, when the last massive crash happened. Financial crisis, US CDS spreads are currently trading at levels similar to Greece and Italy, and their economies are not strong. So it's another problem. These levels signal a growing risk of US default. Comes on the heels of Moody's credit rating downgrade, where the US lost its top rating. Moody's was the last of the three major credit agencies to downgrade our credit. There's one more area of the market that is concerning. Investors need to pay close attention to a relationship that's breaking down in the currency market. The US dollar index DXY tracks a basket of major currencies compared to the dollar, including the euro, Japanese yen, and British pound. When DXY moves higher, the dollar is strengthening against other currencies. When it falls, the dollar is weakening. Over the past year, the S&P 500 and DXY became very correlated. Higher or lower, they tended to move in the same direction. Here's a chart from last year. So there you go. DXY black line peaked at 1 over a month before the S&P 500 blue line put in the February top. But both plunged in early April due to uncertainty caused by tariffs and trade wars. Following a pause on tariffs, the S&P 500 and DXY both found a bottom around the same time at 2. But look at what's happening since then. The S&P 500 has recovered almost entirely from its plunge. Meanwhile, DXY still hovering near lows. The relationship between dollar and the S&P 500 has broken down. Changes in the economic growth outlook and concerns over fiscal imbalances like too much government debt, definite spending can impact currencies. A weak dollar, breakout in longer-term bond yields, rising CSD spreads are all evidence that big problems are looming over the economy. The Federal Reserve deficits are expected to range from 1.7 trillion to 2.5 trillion every year over the next decade. So the trade war could complicate matters if the economy suffers. With that in mind, Larry goes on to list trades for his month, which I'm not going to go into in this video. So basically, whilst the market is incredibly buoyant at the moment, a lot of investors are excited that S&P's back, and a lot of especially the tech stocks, have really bounced. There is trouble on the horizon. So I think the big takeaway of all of this, I know this is quite technical, even I sort of struggle to sort of understand some of this technical stuff. The thing you need to know is that there is troubling times ahead, and the market, the S&P 500 and other stocks could easily snap back and dip. And the big picture I want you to see here, and Larry wants everyone to see, is the market is going to remain volatile. Yes, things have picked up massively, but doesn't mean that we can't see another sharp downturn. Obviously, you've got to bear in mind as well that it seems like Europe is really trying to escalate war with Russia. A major escalation there could have dramatic effects on the economy. If there is a major escalation in Europe with Russia, it's not out of the realms of possibility the US could be dragged into some kind of war with Russia. Whilst at the moment that seems unlikely, it does need to be taken into consideration. This war doesn't look like it's going to be resolved anytime soon. So that is something you need to keep an eye on as well. A major sudden escalation could massively harm markets in the economy. So on top of this, I think you need to bear in mind that the Ukraine war is still rumbling on, and any snap escalation or sort of false flag attack that sparks a major escalation could really harm the market. So you just need to think volatility and trade as such. And Larry at the moment he's basically one of the best traders out there for trading volatile markets. He uses options to trade volatile stocks, or when stocks get volatile. And with options, you can bet on stocks going up and down and profit off that. I'm not going to go into why, because it's out of the scope of video. But also, Larry's also dropping leveraged ETF trades at the moment that allow you to basically make 2x to 3x daily gains on certain stocks. So basically, they're perfect for trading volatile markets. And by trading options and leveraged ETFs, you can take advantage of all of the volatility that we're going to see in 2025. I mean, Larry believes, and I think the market is going to be very volatile this year. I think it's going to be very topsy-turvy. Yes, we're up at the moment, but it wouldn't surprise me at some point in the next couple of months we see a very snap back in the market. But also many of the individual stocks are very volatile as well. So there's so much. Whilst obviously the market is buoyant, you do need to be careful out there, because we could see a sharp snapback. But most of all, we should be excited, because all of these volatile markets, show massive possibilities for us to trade the volatile market. So yeah, just a little tip for you there. Don't be scared of volatility, because usually in volatile markets, that brings the biggest profit potential. And just to finish, some of the wealthiest people on the planet have made their wealth through major market crashes because they bet against the markets, and hence they made an absolute fortune. So, whilst things are buying, potentially volatile times ahead, but don't be scared. It's potentially time to profit from any volatility we see over the next couple of months or throughout 2025. And also, if you want to read Larry's excellent newsletters like this, or get any of his options trades or leverage ETF trades so you can trade the volatile market, so you can hedge any of your retirement funds you've got to hedge against any losses in dropping stocks or volatile stocks, why not give One Ticker Trader a try? I've been a member since 2022. I love it. So if you want to give it a try, do believe you can join now for $79, which locks your membership in for 1 year. I do believe you get a 60-day money-back guarantee. If you want to join, I'll leave a link in the comment description below, and you can read this, this newsletter for yourself and devour all of his special reports he's released on leverage ETFs, stocks to trade volatile markets, and obviously get his monthly options trades and his leverage ETF trades. All right, if you want to join, link in the comment description below. Anyway, I hope you got value out of this video. If you've got any questions, ask them below, and thanks for joining me.